Welcome back to the Isn't That Rich podcast. I'm your host, Jill Franks.
And I'm your host, Ashley McVicker. And today we are talking about something that could literally change a person's life. We're talking about how you could get $10,000 towards your dream home.
Yes, and we're bringing on our Chief Mortgage Officer, John Streuter, to talk about a program that a lot of people don't even know exists. And that program's the Downpayment Plus Program. And it's sort of a grant. And if you don't know what that means, John's going to explain it all today.
Yeah, so it's not a loan. It's not something that you have to pay back. It's actually financial assistance for qualified buyers. And Farmers State Bank is one of those participating lenders.
Yeah, so if you have a steady income, decent credit, and you're ready to become a homeowner, this might be an option for you. Yeah. So let's bring John on, and he can explain this. Welcome, John. Thanks for being here this morning.
Absolutely.
Yeah.
Great to be here with you.
You love to be on the podcast, don't you?
I do. I enjoy this.
Yeah, it's fun.
I said that earlier this morning to Jared. I was like, John's going to be on, and he always gets so excited.
Yep, this makes my day.
Yeah, we love having you on,
This
John.
is the funnest part of doing what I do.
Well, it's our favorite part too, I think.
Yeah.
Yeah, it's a good time. Good time here on the podcast.
John, let's get started. What is this Downpayment Plus program for home buyers?
Downpayment Plus Assistance is a grant program through the Federal Home Loan Bank. And I'll probably get a lot of talky about stuff, but I'll try to be brief on some of the items. Federal Home Loan Bank is a kind of a government organization similar to the Federal Reserve. And for community reinvestment, they set aside so much of their profits each year for these community grants. So the one good thing is this is a private organization that makes this money available. It's not tax money. It's not coming out of your taxes. You're not paying any taxes. The Federal Home Loan Bank is a what they call bankers bank. It's where banks borrow money from, similar to the Federal Reserve. So they worked with savings and loans back in the day, and a lot of savings and loans have gone out of business. And so now their primary focus is with community banks. So most community banks have a relationship with the Federal Home Loan Bank.
Well, it's interesting you said the tax thing, that it's not money that's taken from the public in taxes and then redistributed for this program. So
Correct.
that I feel like that's
that's a big plus.
Yeah.
You know, a lot of people, when they hear about these programs and the government's giving away free money, they say, yeah, I'm paying for it. So, you know, in this case, you can say the banks are paying for it because their profits are generated by the interest that banks pay when we borrow money from the Federal Home Loan Bank for different purposes. So this doesn't come out of any individual pockets. Your taxes aren't affected by this. And so it's a great program. And again, it's community reinvestment. The whole purpose is to reinvest back into the community.
So is this a new program, or has it been around for a while, and how long have we participated in it?
It's been around for a long time. We started participating in it, I'd say 5 years ago. The bank's always been a member of the Federal Home Loan Bank, but for whatever reason, we haven't really participated in this grant program. So it's been around for decades, but we just started participating in it about 5 years ago. We really haven't been active in it. I'm making a point to make sure that we find people to use this program because it's free money. Our bank has been allotted $1 million to be able to give out. So that's 100 customers that we can serve with $10,000 grant program.
Within a year?
Within a year's time. Yeah,
Wow.
it's re-allotted every year. So that goes on a year-by-year basis. So this money has to be used by December. And then next year, they'll come out with a new program. These grants started years ago as little as $2,500, and it's grown up to now $10,000. And when all the money doesn't get used in a particular year, then that money gets held over and used in a second year. But most of the time it gets used up.
I want to know, who is this grant for?
So this grant program is going to be, you don't have to be a first-time home buyer, but you can't own an existing home at the present time. So you got to be repurchasing into the program or into a home at that point in time. But it is for what's considered moderately low-income borrowers. So it's not going to be for everybody. But the income guidelines are for our market are pretty good. So there's a lot of people that we can assist with this $10,000 grant program. The money can be used for both closing costs and or down payment. And the borrower only has to have $1,000 contribution into the purchase process. So very little funds have to be used by the consumer to get into the program.
Do you know what the exact
Income
numbers
level?
are? Yeah, income level
I do.
is.
I brought my cheat sheet.
Yeah, let's go through
I
that.
have to put my reading glasses on. So for a single person household, and this covers all the counties within our market area. So this would be Williamson County, Saline County, and neighboring counties. A single individual that makes $48,550 or less can participate in this grant program. Two-person household goes up to $55,000, and a four-person household that we commonly see is $69,000, so $69,000 and below. And if it goes all the way up to eight-person household, that goes to $91,000 or less. Typically, what we see is one-person household, two-person households, four, and then usually five or six is typically the highest that I ever see. A six-person household is $80,400.
So I'm confused about what a four-person household is. Does that mean my husband, myself, and my two kids, or what does that look like?
That's correct.
Okay.
So a four-person household is going to be four individuals living within the household. So it can be you, your spouse, and could be if you're caring for your mother-in-law, your father-in-law, your father, mother, if they're living with you full-time, that could be now part of that household. Doesn't include dogs and cats. I know that we love our fur babies, but we don't include those. An interesting question that comes up every year, it does not include somebody that's with child. And I get that question quite often, is because somebody will be a two-person household and they might be right on the cutoff line and they said, oh, I'm pregnant. And well, you're going to have to wait until you have the baby in order to call that a three-person household.
Interesting.
And I also want to just clarify one thing he also said. So if I'm a homeowner right now and I meet this income qualification, I sell my house and I can buy this new one with a down payment on this, or no?
Correct.
Okay.
And as long as you're within the income guidelines.
Okay. Got it.
So we talked about income guidelines. You said a few other things. Like, what's the catch with this? Is I feel like this is too easy,
correct.
kind of like, let me get $10,000.
The catch primarily is you have to be within those income guidelines.
Okay.
And there's going to be a lot of people who are going to be above those income guidelines. A two-person household making $25,000 each, $30,000 each is easily going to be outside that income limit pretty quickly. So that's the biggest catch. It is a community reinvestment program, so outside of that, there's really no other catch. A couple of things that you have to do as the homeowner is you have to have $1,000 of your own money that you can contribute to the program. That money can't be gifted, can't be borrowed, so you do have to have an actual $1,000 of your own money that you're putting into the program. The other thing that you have to do is you do have to go through a home buyer class. So you have to go through home buyer counseling and through an online program. So you do an online program through a designated group, and we have a couple of groups that you can do that with. And then they set up a phone call for counseling. And that costs about $350 to do that, and you have to have that money as your upfront cost. But that $350 is then we get the receipts for that, and that's part of that $1,000 contribution.
Okay.
So it's not in addition to, that's part of that $1,000 contribution.
You know, we were talking about this yesterday, and I think everyone should have to go through home buying,
kind of home buying
education.
class.
Because I remember when I was doing my mortgage with you, and you're like having me sign all this paperwork. I'm like, I don't know what any of this means. Yeah, I just think everyone should be a requirement.
And the ironic thing is part of all those documents that we have you sign, the very last thing is a home buyer toolkit, which is about a 10 to 15 page item of all the different pieces of information that you're going to go through in this process. But it's the last part of about 50 documents. So very few people ever get to that toolkit and read through it.
I know I didn't.
Yeah. It's very seldom ever done. But that is part of a normal package now that started with Consumer Financial Protection group, started that and created that toolkit that you have to read through and get that information.
So you have to do this education before you get the loan.
And it's not a loan, right?
Or not the loan, excuse me.
You can do it as part of the process. So years ago, it was a requirement to do this before you could even sign a contract. And they've lowered those requirements. And so you can get a signed contract, do the application for the grant program, and do the home buying counseling and all through that process, because the normal process, as you remember, is 30 to 45 days. So it's not like you have to do this, then this. It can all be done during that same
Got to
process.
get it done.
Yeah.
So I'm wondering how long this class takes. So if I'm expected to do this and I want to make sure that I'm staying ahead of it, how long is it?
Most people have told me that it's a couple hours, a couple of evenings, or if you want to shoot through the online class all at one time, it could take 4 to 6 hours, depending on how fast you read and answer questions. And then the counseling session that they set you up for is about a 45 minutes to an hour counseling session.
Okay.
And they do ask questions. There's no right or wrong. There's no fail. It's just a learning process. So if you get a question wrong, they're going to redirect you and say, give you the correct information, say this is the correct answer and this is the reason why. But you can't fail the test and then not qualify for the grant. You just have to complete the process.
Okay, because that was something I would be worried about too, is what if I don't pass this test? Will I still get the grant? Yeah. But it's not like that.
No, it's more or less quiz oriented, and there's no failure to it. Now, I would go back and say that one other tie, if you want to call it that, is you do have to stay in the home for 5 years. So
it is. I knew there was a little catch.
So if you want, but the other side of it is I would, generally when I've talked to people over the years, if they're looking at buying a home, one of the questions I ask them is, are you looking to stay in a home for 2 to 5 years? If not, I'll encourage people to rent. Because you're just not really going to gain any equity in a property in 5 years. Yeah. And you're probably, as a homeowner, going to have more troubles with replacing a water heater, fixing some faucets, fixing toilets. Why go through that headache if you're only going to be in a house 2 or 3 years?
Right.
So 5 years is in my relative period, is a relative short period of time, and you're going to have some equity at that point in time. So if you stay in the home, let's say you have to sell for some reason, you get relocated. All they do is they prorate the time that you've been in the home, and through the sale of the home, you have to pay back the prorated portion that you have not used. Now, if the sale of the home doesn't sufficiently cover that grant, they will forgive whatever balance of that grant that doesn't cover. So you can't net any positive money,
Right.
but you won't have to bring any money to the closing table if the grant doesn't get covered completely.
So you don't have to pay it back, pretty much.
Correct. As long as you've been there for 5 years, you'll never have to pay the money back. If you've been there less than 5 years and you sell the house for enough money to pay off your mortgage and recover any unused portion of the grant, you don't have to pay it back. And if you don't sell the house for enough money, you still don't have to pay that portion of the grant back. So there's no negative factor here that would say, well, this is a reason I shouldn't do this.
Right.
If somebody does this program, they get the $10,000 grant, and I know you said that they have to have $1,000 of their own money up front.
Mm-hmm.
I think I know the answer to this, but can they, if they do, bring more money to the table
Yes.
for a down payment in addition to the $10,000 that they're getting?
Yes. So if they do have some money saved up and they buying a $100,000 home, and the ideal payment for them is $75,000, and they've got $15,000 saved up, this $10,000 will be a $25,000 down payment and get them to that $75,000 loan amount.
Nice.
That's great.
Now, I would generally say that closing costs are going to cover about $2,000. Your homeowner's insurance is another cost that you have at closing time, and that's going to be roughly $2,000 to $2,800 these days. Mm-hmm. Yeah. I use $2,400 as a general rule of thumb. So you're looking at about $4,400, $4,500 of that grant money being used towards closing costs and your insurance premium. So down payment wise, you're going to get about $5,500 in down payment funds that you can use along with your $1,000 and any additional money that you want to put down.
Is there a, I don't want to call it like maybe a cap, but a certain price point for a home that's like cut off to where, if the house costs $300,000, well, now you can't get the grant anymore.
Very good question.
Obviously, though, looking at people's incomes and I suppose what they could
Correct.
afford, you can't
They don't.
buy $1 million mansion.
They don't. That's a great question, and they don't have a maximum purchase price on any of that. That's a cap on your purchase price. And that's because they do have the income factor in there.
Right.
And somebody at a certain level income, they're going to have to qualify for a debt ratio of no more than 45% for their mortgage. So inherently, there's going to kind of be a cap on how much you can borrow based on qualifying for the loan. But if somebody that doesn't have a lot of debt could easily buy a $150,000, $200,000 home with this grant, and still be able to qualify.
That's great. So if somebody's never really understood what grant versus loan means, could you maybe just kind of explain that? Because that does get a little tricky. I know when we were doing a lot of the PPP loans, it essentially was a grant if you followed the qualifications. So maybe you could explain that.
So the big differences, and there's other programs out there that call themselves grants, but then many times it's a repayable grant where they're only forgiving interest. They're not charging interest on it. So this is a true grant where you're being given $10,000 and you only have to pay it back if you sell the property in less than 5 years. At the 5-year mark, you're done. We do record a document along with the mortgage that says that you have this grant program. So if somebody does go out and sell their property in under 5 years, that's going to come up in the title work, and then they're going to contact farmers and say, okay, we're selling this property, we need a payoff, and we have to calculate the prorated amount along with the payoff on their mortgage. But in this case, the grant doesn't ever have to be paid back, so a grant is a true grant in the sense that you're being granted this money and not having to pay it back as long as you do these couple requirements. Whereas a repayment loan or a repayment grant is usually going to have some time period tied to it. So There's a state of Illinois program that does have a repayment grant that you don't have to repay it until you sell the house. And if you stay in the house for more than 10 years, you don't have to repay the money. If you're in the house less than 10 years, you have to repay a portion of that grant back. They also have a repayment loan program that is a second mortgage that you have to repay over 0%. So in their case, they have a $10,000 program as well, but that $10,000 program you have to pay back over 10 years at 0%. So this is a much better program. We participate in that program as well. It's through IHDA. The benefit to that is their income guidelines are higher. So somebody that doesn't qualify for these income guidelines, then we can look at the IHDA program and see if they could qualify under that program.
We have lots of different loans at the bank, correct?
That's correct. You know, one of the benefits of being shopping through Farmers State Bank is, you know, a lot of us look at it as a small community bank. But I've made a point to make sure that we have all of the mortgage products that any of the larger institutions have. So we can fulfill anybody's needs by coming to Farmers State Bank.
Yeah. So because we have these different options, are we able to maybe pair this program with something like a VA loan? You know, I know there's different types of loans we have that can serve different people for different reasons. And so I'm wondering, you know, is there only a specific type of mortgage you can get with this program?
No, this program is pairable with any other loan programs out there. If somebody has the benefit of being able to qualify, if we can see that they can qualify for the IHDA program and get 2 grants, it's actually a program where you can get double the grant money. Now, the income guidelines and the programs that IHDA has that would fit with this program, you wouldn't be able to get $20,000, but there are some IDA programs where you could do $24,000, $26,000, or I'm sorry, $14,000 or $16,000 with the $10,000 grant money. So there is some ways to combine those programs.
Well, that's encouraging for people because I feel like everyone, gosh, you know, I always say it's like after the last 4 or 5 years and just like inflation and talking so much about home ownership and people feeling like they're priced out of the market pretty much. I think it's nice that these are available for people.
It is. You know, it's right now, home ownership is one of the most difficult things people are finding to do within their finances because they haven't been able to save a lot of money. People are still recovering from COVID financially. And that's probably the biggest thing that we see is people just don't have the funds available.
Right.
Now, we'll generally recommend that they stick with a conventional program, and we'll go through and show them the needs and benefits of all the different programs. This program fits best with what is called the Freddie Mac, Fannie Mae, Home Possible, Home Ready programs, which are designed for first-time home buyers. You get discounted PMI insurance if you don't have 20% down. You get a favorable interest rate. And the income guidelines for this program is a little bit lower than the Home Ready and Home Possible programs. So you automatically will be able to qualify for those 2 programs. So that's where we see the biggest fit with the least amount of requirements. You always want to be cautious when you go into the government loan programs. They're going to have some more conditions that you have to, the house has to meet certain requirements.
I've seen that list.
FHA has to meet certain requirements.
No, I've seen that list. That's the one that's like, wow.
And USDA is another program that this can be used with. Those have, even with VA, FHA, and USDA, those have mortgage insurance that's payable to the federal government that this program doesn't help you pay for. It's part of your mortgage payment. So in that situation, that's why generally with the with the Home Possible program or the Home Ready program, where this fits in real well, because you may be at a 90 or an 85% loan to value, and the PMI will automatically drop when you reach an 80% loan to value. With FHA and USDA, that's a life of loan premium. It doesn't automatically drop. But I'll go through all those details with a customer and say, here's what fits. People don't have to decide, well, do I need this program?
Right.
What they need to do is come to an expert like all of our mortgage people at Farmers State Bank and say, what program is going to be the best fit for me? And then we can lay them side by side and show them exactly what's going to work.
So if somebody's listening to this and they're like, well, this might be something I'm interested in doing, what's the first thing they need to do?
First thing to do is just call any of our mortgage specialists at Farmers State Bank and say, I heard about this $10,000 grant program. I'd like to know more about it. We'll set up an appointment to come in, have you pre-qualified. There's no cost to pre-qualify. We'll do a soft credit on your credit pull so that you're not affected by that credit score. And then we can look and see how things look. There's no credit score requirement with this program because they know that the loan programs are going to have credit score requirements. So they just look to the bank, and if it's a qualified loan, then you can get the grant money. There's no additional qualifications for that grant program.
So if someone does have terrible credit and let's just say lots of debt, like a super high loan to debt to income. That's what I'm always trying to say. Can they be kicked? Could we deny them essentially and just say, I'm sorry, you're too much of a risk for us, even though this $10,000 grant doesn't have a lot of requirements. Farmers Still Bank still has requirements.
The loan program that you qualify for, you still have to qualify for a loan program to be able to get the $10,000 grant.
I just want to make that clear.
Now, the other thing that they have to do is they have to get the grant through us and the loan through us. They can't come to us and apply for a $10,000 grant and try to get the loan through another financial institution. They can't say, I'm approved with Rocket Mortgage and I want to get this $10,000 grant. So it all has to go hand in hand. You have to get approved for a mortgage loan with us, and then we go through the process of applying for the grant for you. Now, that's the other easy part, is there's very little paperwork. We do the paperwork. There's one form and application, and there's a couple forms at closing time. We do all the paperwork for you. We make the application for the grant. We arrange to get the grant money. The bank fronts the grant money and then gets repaid by the Federal Home Loan Bank once the loan closes. So there's not any type of extra work that you have to do. It's all part of the same process as applying for a mortgage loan.
That's interesting. I was going to ask that if you could get them separately. And also, not all banks are participating in this, correct? Because I was looking at that Excel spreadsheet, and I could see all the banks, but I didn't see a lot of the local banks on there.
Yeah. Generally it's going to be community banks. You're not going to see any of the larger institutions that are members of the Federal Home Loan Bank system. But it has to be somebody who's part of the Federal Home Loan Bank system. And they also have to have signed up for this grant program. Not everybody signs up for the grant program.
Yeah.
I know that you've actually done a few of these for people. Could you give us, obviously no names, but just maybe an example of their situation and just kind of how everything played out?
Absolutely. Over the years, I've done this program many times. I've used this program before I came over to Farmers. So when I came over to Farmers, it was a priority to get us signed up for this. Most recently, we had a customer out of our Harrisburg office that we were able to provide the grant to. She qualified for the full $10,000, and she was buying a $50,000 home. She was able to cover all of her closing costs. We were able to put a down payment towards that. She started out with a loan of about $43,250 on a $50,000 house at an 85% loan to value. So within 2 or 3 years, she'll be at that 80% mark and be able to take PMI off of the loan. And she literally barely had $1,000 to her name at that point in time. Her parents were in the process of selling and buying a home, so even though you can't get funds from parents, but they were not able to assist her on a normal conventional purchase. And under any other program, she wouldn't have qualified. She would have needed more money than $1,000 to qualify for any basic loan program. But with this, we were able to give her the $10,000, pay down on her loan, pay all of her closing costs, and she scraped together the $1,000 and now a happy homeowner.
That's so cool.
Let me ask you this question. This just popped up in my brain. So, and maybe you answered it earlier, but let's say it's this single person, and what was the income level for them?
49?
40, yeah.
I feel like it's 43, 49.
48 maybe?
48,550.
So let's say they're at that income level. Let's say they have no debt, but they've never had debt before. They've never had a credit card. They're basically a credit ghost, as Kelly Green likes to say. Oh. They have to go through a loan program with Farmers State Bank. Do they have to have a cosigner, I guess is my first question, since they don't have any credit history? And if they do have to have a cosigner, does that affect this program because the cosigner
income?
Because of the cosigner's income?
Yes.
So I found another catch, John.
Yeah, okay. I guess you caught me. We have another catch in there. So the program, you do have to qualify as a borrower. With this program, you can't have what we would call non-occupant co-borrowers. Okay. So you have to be able to qualify for the loan in your own name, and only people that are going to be living in the household are going to be able to participate in this program. So,
and you've been saying that, like, parents can't help with this or it can't be gifted to you. So I think that's where that question's sparked.
Correct. Well, that's a good question. Is somebody, and generally in the mortgage business, we don't really use what's called cosigners. That's one of those misnomers that people always think, well, if I got bad credit or if I need help, I can just get a cosigner. Mm-hmm. Generally, that's just consumer loans, car loans, single pay notes, things of that were a short-term loan. Mortgage loans, the borrower who's occupying the home has to qualify for the program from a credit standpoint.
Okay.
Now, you can have what we call non-occupant co-borrowers for programs where somebody's income can help you get qualified for a particular home. That would not be the case with this grant program.
Okay.
You may be able to qualify that way with a loan, but with the grant program, we would have to factor that person's income into the picture, and that would generally toss you out of being able to qualify for that program. So you need to be able to qualify for that person, or just individually on your
own. Yeah.
Now, one thing that leads to that, though, as far as income qualifying, is that is household income. That's not your job income. So we have to factor in your job income. We have to factor in any overtime that you generally would get. If you're collecting disability for a child in the home or for an adult member of your home, that's considered household income, and we do have to we have to use that as the qualifier for whether your household income meets that guideline. So that's one way that somebody could maybe get caught under that is, oh, my salary is under that level, but I do get money from the state or from the federal government because of a disabled child, or somebody may have foster children, and we have to include that foster income into that household picture. If we're including, and that gets into a sticky wicket, so I'm not going to get into the long conversation about that. If you have a household with foster children, just contact me and we'll talk through the process.
Right. Question for you, and this kind of like Ashley popped up after the fact. So I lived in this house 5 years. I'm considering moving, different locations, still in Illinois. Can I requalify for this grant?
You can, as long as you're not a current household member, and you're buying a home and getting the grant money for the purposes of, buying a home if you're within those income guidelines.
Okay.
Is there anything else you can think, because I keep finding stuff out about this program. Is there anything else you can think of that people would need to know about this program? And I mean, it sounds pretty easy to me.
It's very easy, but you'll always get a unique situation where, the best case that I can say as far as, somebody that's maybe selling a home is maybe somebody who's relocating because of their job from Springfield to Southern Illinois, or from Northern Illinois to Southern Illinois, where they have to sell the house up there. They need to buy a house down here, and they didn't make enough money off of the sale of their home. We can requalify them under this program to help them out. It's typically not going to be the type of person who's selling a $300,000 home and I'm downsizing to a $150,000 home. That you're probably going to be within the qualifiers to get within that, unless, there could be unique situations. I found where homeowners are getting divorced, and one of the spouses is keeping the residential home. You've signed your interest away from that home, and the other spouse is needing to buy a home and needs assistance with that. So that would be a good reason to give us a call and talk through that process. But otherwise, it's pretty easy. As I said, the main pointers, it's not a government program. Your tax dollars aren't being funded. This isn't being funded through your tax dollars. It is a community reinvestment program. It is done through community banks that are part of the Federal Home Loan Bank system. Generally, as long as you're buying a house for more than $50,000, you're going to qualify for the full $10,000. They do have a cap of 25% of the purchase price of the home. So it's like, I think 40,000. I don't do math in my head real well, but under $50,000, it may have a smaller maximum limit to it. But nowadays, in our market, you can't buy a reasonable home below $50,000. So that's why I don't really worry about somebody not being able to get the full $10,000.
Do you think that we will use all of the money this year?
We will not, because like I said, it's 100 customers.
That's a lot of customers
that we could benefit from. There are a few other institutions in and around Southern Illinois that participate in this program. So, they're obviously going to do a few of these loans as well. So, my hope is through 2025 that we help at least 20 customers. And then from there in future years, hopefully we build from that.
That's great. So if we were to ask for that little income eligibility chart, is that something we could link in our show notes, or
yes,
is that something?
We sure can.
Okay.
Yeah, it's information that we can share publicly. There's no exclusion to that. And it's based on HUD income limits. Okay. So there's income information that people could look up on a government website, but we're not going to try to tell them how to do that.
No.
Because they'll get confused and not know where to go to. So we'll be happy to provide that and put that as a link.
Wonderful. And so you said the first step is to contact you.
First step would be to contact any one of our mortgage specialists with Farmers State Bank and just say, I'm interested in the $10,000 grant. Don't even need to remember the name. DPP, Federal Home Loan Bank. Don't worry about that. Just say $10,000.
I want $10,000.
I want $10,000. Yeah. And the best thing for us to do is to set up an appointment. We can talk with you over the phone, but I find the best thing for us to do is to go ahead and have you come in, because we do have to qualify you for a mortgage loan to be able to qualify you for the $10,000 grant.
Yeah, you're not getting away from that. You still have to
you still have to qualify for that.
Bring in your income statement.
If you say, well, my credit's not good. Well, this program generally continues year to year. So I would encourage you to come in, let us sit down with you and counsel you on how to improve your credit so that we can say, this is what you need to do to qualify for a mortgage. And then at that time, we can then qualify you for this grant program. So they've been doing this for 20 years at least.
You don't see it
And
going away?
I don't see it going away.
Okay.
Because it's part of the Federal Home Loan Bank CRA requirement. All of us banks have Community Reinvestment Act requirements, and this is how they meet their CRA requirement with the federal government.
Wonderful.
So, John, if people want to talk to you, how can they get a hold of you? Where do you work?
I work at Farmers State Bank. So you can always reach me at Farmers State Bank, where no one serves you better.
Perfect.
But the phone number to call us, and it'll be in the link as well, 998-1188. And that will get you to, the way our phone system is, that will get you to any one of our mortgage specialists, regardless of what office.
Yeah.
If I'm busy, the customer is going to then find the next mortgage person to get on the phone. So we always have live people answering our phones.
Yes.
And we're going to make sure that you get an individual that can answer those questions. So you don't have to worry about, I'm in Harrisburg, I'm talking to Kelly in here, and she'll answer the initial questions. If she needs to arrange for you to set up an appointment with Taylor in Harrisburg, we'll get all that arranged for you. So don't worry about that. Just call 998-1188, and we'll take care of you.
You know, I just had an argument with Ashley this morning. Not an argument.
Did we argue?
No, it was about 618.
Oh, I think everyone's phone number starts with 618.
You know, because I'm a 320 girl. I'm not from around here, and I've kept that since. So I always make fun of Ashley. She never says the.
She's like, you always think everyone's phone number starts with 618.
I'm old school. I remember when you used to just dial 81188. So you didn't even need to worry about the 99.
618. Yeah.
So yeah, it's hard for me to always say 618 because I'm just like, well, everybody here in Southern Illinois is 618.
Yeah,
so
I think that too.
Except for us transplants.
This isn't a cell phone. This is a hard line, and
Yeah.
you'll get a live person that will answer the phone. We're very particular about that at Farmers State Bank. We want to give you a live person that will direct your call correctly the first time and get you directly to a mortgage person. So just say, I'm interested in the $10,000 grant, and they'll know how to direct your phone call.
Perfect.
Well, thank you so much for being on.
You're welcome.
Thanks, John.
Thank
Yeah.
you for having me. I think it's a great program that we need to get more people interested in and tell them about, because as you said, not a lot of people know about it.
Definitely. Well, I've learned a lot. So
Me too. Thanks for being
Good
on.
deal.
yeah.
So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.